Welcome back to Purpose Driven Passive Profits. If you have been hearing in the media that there is less inventory than there is demand, and that's what's going to hold up our housing system, this is the show where we are going to show you that dam is breaking right now. We are going to jump into it. We're going to show you how this is true. We're going to back it up with some stats, and we're going to tell you what this means as an investor. If you are looking at multifamily, we're also going to talk about how this is going on with multifamily apartment complexes.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
If you're new to the show, his name is Nate Armstrong. He is the founder and CEO of Home Invest. My name is Steve Warner, and I am your Chief Investment Officer, and this is Purpose Driven Passive Profits. Nate, let's go ahead and jump right into it. We've been hearing for a long time, like the housing market, we're not in a bubble, nothing like that is happening because there is more demand than there is supply. What is happening right now in the world that's changing that?
Yeah, so the narrative that the housing market won't break, it's a false narrative, and that's not possible. If you look at the history of real estate market, there's always ups and downs. But here's what is true. The truth is that there is a shortage of inventory, a shortage of houses compared to the usual norm, the average norm. But that shortage is not very much. That's what they're not telling you. And that shortage is disappearing rapidly right now as people are cutting prices and all kinds of craziness is happening with interest rates being high. So what are the actual numbers? Well, as of 3 months ago, we were 1 million homes short, 1 million homes short. How many houses are there in America? 140 million, depending on who's doing the measurement, but that's the approximate of the three. 140 million. So that's less than 1% we're talking about. It doesn't take that big of a needle mover or a game-changing moment to change the inventory by 1%. I want to put that in perspective. I mean, for goodness sakes, just a couple of weeks ago, the entire New York City just banned short-term rentals. They're forcing a whole bunch of short-term rental owners in New York City, 100,000 of them, to now either sell their property or rent it out as a long-term rental. And the majority are going to end up being a potential sale position, is what I believe. So the inventory is going to change really fast. I imagine they have not released this quarter's inventory results yet. I haven't seen it posted by realtor.com yet, and I watch for it all the time. But I imagine we're probably down somewhere around like 700,000 houses short. And as we go into the fourth quarter of this year, it's only going to dramatically decrease in number. I think we're probably going to be at par, a balanced inventory market by probably January or February of 2024. And then as we're watching right now, because of all of these high interest rates, buyers are on strike right now, and sellers are forced to drop their price. Sellers are forced to lower the price to meet the demand of the market. And I think that 2024 is going to be the year that we actually see the big discounts take off.
Okay, so I want you guys to think about that. 2024, real estate moves a little bit slower. 2024 is when you're going to start to see it. But like foreclosures right now, like foreclosures, the government said no foreclosures during COVID. That expired 6 to 8 months ago, and we're starting to see a lot of those creep up. What are we seeing in multifamily, Nate?
Yeah, the multifamily, let's call it the multifamily meltdown, if there is one. So it's interesting because in times of recession, money flocks to multifamily. Smart money, smart investors, they put their money in multifamily because they know that everybody needs a place to live. So even as they vacate their single family houses, multifamily occupancy rates tend to be really, really high. But what wasn't a factor in the last downturn is everyone that took out a rehab loan or a short-term loan to buy a multifamily property. They were very, very popular during the pandemic. They were very popular up until about even 2-3 months ago. And even still today, there's some people taking out short-term debt on multifamily properties. So where the meltdown, if there is one, will occur in multifamily is for people that took out short-term loans, expecting interest rates to remain low. What they're finding out now is that interest rates are skyrocketing. And so when they took out that loan product a year ago at 5%, and today they have to wake up to a new payment that's at 7%, it's a shocker. It literally moves a mortgage payment in some cases on these multifamily properties from 45 grand a month up to 65 grand a month, depending on the interest rate and the terms and all that kind of stuff. So that's where there's going to be a shake loose of some properties in the multifamily sector, or people that just didn't anticipate the future. They didn't have the crystal ball to pull back out 3 years ago and figure out that interest rates would be this high.
Well, there's a wall of those coming, because it's a lot of people that took out the loans in 19, 20, 21 when they're like, oh, this is going to keep going. That's what's starting to hit right now. And it's like, it's literally, I heard it described as a tsunami, right? So there's like water, and then it all sucks back and it builds this huge wave. And that's what's happening. And that is what's heading. What does that mean for somebody like you and me, Nate, who goes out and we find these great deals for people to invest in? What are we going to see, like you and I, in the next coming, I would say, like 12 to 18, 24 months?
Yeah, well, I'll address that, and I also want to address that we don't play with fire here. Like our moms and dads taught us very well when we were young not to mess with fire. So we don't mess with those short-term loans. So we're not in that position, thank God. But for all of the syndicators out there that did take out massive amounts of these loans like that, they're going to be forced to sell. And then what people like you and I, Steve, along with our investors, like the folks that follow us here on this show, we get to step in and buy a lot of those properties. We actually have one right now under contract. It's a $12 million deal in the middle of Kentucky, in a great little city that we love. The seller's loan expires in December. If they don't have that loan paid off in December, they're at risk of foreclosure. They literally could get foreclosed on. And they took out one of those rehab loans. They didn't know what to expect, and now they got the pinch. And so anyways, that's our first one that we're picking up, this $12 million deal. God willing, everything will go through. But there's going to be more. And when we can find deals like this, we're buying them. Some people are saying it's hard to really put a number on this, but because interest rates have gone up so aggressively, some people are saying that for the next 12 months or so, we're going to be buying multifamily at a 29% discount, 29% less than what you would have paid normally. Multifamily typically doesn't have a 29% drop. That's very, very rare. If you historically look back at the multifamily sector since they started tracking it heavy with data in the 80s, you will not see a 29% drop in a year. Just, it doesn't exist. And so this is a really unique opportunity for us to step in and grab some of these assets.
That I couldn't have said any of that better myself. Like, we are going to see, for syndicators and people like us that go out and find great deals, we're good at operating them, we are going to see chances to buy stuff at deep discounts, which is going to flow through to our investors. Our investors are going to see this. One of the things, you've seen a lot of syndicators right now that aren't offering dividends till year 3, year 4, because of the price structure that's up front. But what we're able to do when we find a great deal, we always pay dividends from day one. I guess always might be a strong term. We have never not paid dividends from day one. I don't see a time in the future when that's going to change. If you guys would like to learn about our current offerings, you can go to homeinvest.com. That will take you to a link where you can book with myself or Sue, our head advisor. You can also click in the link description down below. That link right there, it's homeinvest.com/book, will take you directly to our booking calendar. I would be happy to go through any of our current deals with you and show you how, one, we got them, two, we usually have them at a great interest rate because we do a lot of assuming loans or owner financing, and three, like how you will get paid. We offer usually up to a 16% IRR and up to a 1.8x multiple on your money within 3 to 5 years. Nate, anything else when it comes to this dam breaking? We're starting to see more foreclosures and what we're seeing in multifamily. Is there anything we missed that you want to cover?
Yeah. So Robert Kiyosaki, author of Rich Dad Poor Dad, he has publicly come out now and said that the dam is breaking because of short-term rentals. Short-term rentals, they swelled. There were a ton of demand for it. Now all of a sudden, they're broken. They're not cash flowing anymore. They're losing money. And so there's a tsunami of them coming to the housing market for sale. So watch that inventory change. I know that sometimes when you're waiting for it all, it's not like the stock market that's instant. This is more like if you were on a roller coaster sitting in the caboose, the very back car, and you can picture the front car, it's already hanging over the edge. Like you can hear the people screaming from the front of the car. You're still in the caboose. It takes some time before that caboose is going to go over the hump, but know that it's coming. It's coming. It's going to come strong. And then once it comes strong, it'll be fast. It'll be a faster drop down, but it's slow in the beginning. So have a little patience. Put your money in safe spots right now. I think that this next 12 months is our window. If you're ever looking for a time to place capital in multifamily property, do it over this 12-month window that you got in front of you.
Awesome. All right, guys, we will see you next time here on Purpose Driven Passive Profits. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors. I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose Driven Passive Profits.